Welcome. In this video we'll walk through how a bank-funded Indexed Universal Life Insurance Plan, or IUL, works as a retirement strategy. This approach combines your own contributions with additional funding from a bank, helping to maximize the policy's growth potential. Let's break down the process, step by step. Step 1. As the investor, you contribute a minimum of $25,000 per year for the first 5 years. Step 2. At the same time, the bank contributes $75,000 per year for those first 5 years, significantly increasing the policy's funding. Step 3. For the next 5 years, the bank fully funds the program, allowing your contributions to stop while the policy continues to grow. Step 4. In the final 5 years, no new contributions are made. The money remains in the policy, maximizing its growth potential. After 15 years, the bank is repaid its share, and you are left with the remaining cash value to help fund your retirement, along with a substantial death benefit for your loved ones. This strategy is often best suited for high-income earners who are seeking tax-advantaged growth, supplemental retirement income, and a significant death benefit. Bank-funded IUL plans can be a powerful tool for those who qualify, offering a unique way to build wealth and protect your family. For more information, consult with an advisor at Vitality Wealth Advisors to see if a bank-funded IUL may be in your best interest.